You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
People are always asking me if the hedge funds are still buying real estate, and if so, where? And will they eventually dump all their holdings once they're tired of real estate and ready to move on to something else, which could potentially flood that market with inventory? I'm Kathy Fettke, and welcome to The Real Wealth Show. Our guest today will address this issue. JP Ackerman leads the Strategic Real Estate Product Division of HouseCanary. His specific focus is on the development of analytical products for new home construction and institutional investors. JP was previously the Area Vice President of Strategic Marketing at Pulte. During his 10 years there, he led teams of analysts throughout the Western U.S. in consumer analytics, acquisition underwriting, and the positioning of Pulte's multi-billion-dollar portfolio of land. JP was one of the guest experts on a panel I was moderating a few weeks ago at the IMN Single Family Rental Forum in Phoenix, where the largest hedge funds were present, along with midsize and the new smaller funds, to talk about the state of housing. And I was really impressed with some of the things JP said, so I invited him to be here with me on The Real Wealth Show. So JP, welcome.
Thank you very much, Kathy. Great to be here.
It seemed this year like the players have become a little more seasoned. So many of those Wall Street guys jumped into the single-family rental market with almost no experience in real estate and made a lot of mistakes. But now they seem to have more gray hair and the experience to truly call themselves real estate investors. Would you agree?
It's a great way of putting it. Yes, I think people are recognizing, and some already have for some time now, but I think the bulk of the industry is recognizing this is not just a home price appreciation play. And if you look at most of the institutional investors going back 4 or 5 years, when they had the thesis to begin in this industry, it was about buy homes cheap, get occupants to ensure the homes aren't dilapidated after the 5-year investment cycle, and then dispose of them. And what we've seen is this migration from people believing that this is about a flip and beginning to understand the long-term yield opportunities of generating income and wealth through this. So, the funds certainly have realized enormous appreciation in their portfolios, but the reality is what they've been able to do over the last 4 or 5 years is also bring to fruition very well-tuned providers of services to support a distributed network of homes and create a very efficient cap rate on it. So they've been efficient in terms of providing property management services, caring for the homes, interfacing with customers. And while we don't necessarily see the same sort of revenue and asset management platforms that are in the marketplace in the multifamily space, what we are seeing is the maturity of how they manage them. So they're doing it still by a lot of sheer grit, but they are using more advanced analytics and more thoughtful approaches to do so. So I think when I made the comment about they're not looking for the big tranche of dollars, say the 20-30% home price appreciation. Rather, how do I take a $1,200 rent and make $1,210? What can I do to better align my leases with seasonal patterns so I don't have these long vacant periods? How do I minimize the investment spend to be appropriate for that asset and its ultimate value? These are a little bit of less exciting individual questions, but this is what you do to expand margin. We're talking basis points, not percentage points.
Really interesting perspective, because Wall Street today seems to be more of a speculation appreciation game. I mean, it's very rare that you would buy a stock and expect any kind of cash flow from it, like you might have decades ago or centuries ago. You'd buy a stock and hope to get a dividend, and nobody even talks about that anymore. But I should say not nobody, but it's rare. But it seems like the cash flow game has become a very desirable one and very profitable one for Wall Street guys. I mean, I have close friends who work for high-tech companies, and I won't mention the names, but you see it all the time now where companies aren't just selling software packages, they're selling membership. You have to go online and pay $10 and that's value. But, companies want to see that incoming cash flow. And so it's interesting to see that the hedge fund guys are seeing the value to that cash flow as well versus appreciation.
Yeah, I think there's been a migration to a degree of this being that kind of investment vehicle to put money to use during a down stock market and transitioning into a yield producing machine. And, I think that you've seen many of the large portfolios go public and take on the REIT structure in a way that they're going to be hyper-focused on yield going forward. And I think that's, in a way, a lesson to all of us investing in this marketplace. And that if you think short term, it can cause you to make some really bad decisions. But thinking about the long term and how to extract ongoing opportunities out of this installed base of homes. And I do think you see many of the kind of pure hedge fund investors getting out of this business in a way and transitioning into a structure that can be bonded, where it can be focused on ongoing management and operations. And I think these investment vehicles that started the industry are, in a way, morphing into different platforms. But, those that are continuing to invest are taking a very different profile of in the backing mechanisms. So I think that very risk-loving investor from 2010, 11, 12, that tolerance for those guys, they're looking for so much in terms of return that this may not necessarily fit the same mold, but they're maybe divesting themselves somewhat, but there is an enormous amount of the audience that's hyper-focused on that cash flow, as you discussed.
Interesting. All right. Our panel at the conference was on demographic trends. What stood out for you? Some of the comments we had the Atlanta Federal Reserve guy there, and we had a big-time builder, and then another hedge fund. I mean, out of all the commentary we had, what was kind of the general theme?
Well, I would say that the thing that I was surprised by, and I think this is a lesson to all of us in any industry, and specifically in residential real estate, is that this comes down to the consumer, whether it's the consumer that's in the house, whether it's the consumer you want in the house. This is all about a consumer play. And I think everybody had concern that it was a pretty opaque marketplace, and we didn't really understand who the consumers were sitting in the portfolios in these individual homes, and ultimately, how do you serve them? So I think when you look at what the Federal Reserve is struggling with right now, it's the concern that they have on how to provide home buyers the opportunity to get into their first house, and whether or not to support or how they can play in the space of single-family rental and be a conduit for greater opportunity, both in terms of fulfilling their mission as well as supporting those that are investing in stabilizing the economy. The consumer question, though, I think is a big one because so often real estate becomes a financial play. And if you look at whether it be a home builder or a single-family rental owner, it's a matter of investment. But what I think everybody is beginning to realize in this maturing industry is that investment vehicle that's nicely aligned with the demographic trends, and not at a macro level, but rather at a hyper-local level, down to the individual consumer out there looking to rent a home. And so I think from the operators that were on the panel, great to see that they're thinking about the question because, as a owner of a property, you want to tailor it to get the greatest rent by making sure that you have the right fundamentals within the property, have the right bedroom count, bathroom count, have got the right sort of finishes in there to suit the needs so I can create the best experience for the consumer, generate the most rent. And there's a lot of research being done around that. So I was really impressed to see that aspect of it come to life. And, frankly, even more impressed to see that the audience was so engaged in that aspect because generally speaking on that can be a very ambiguous discussion, but I think we got great questions and insights from the audience of how they're tackling it.
Yeah. Well, with so many markets experiencing significant rebound in home values, maybe too much of a rebound over the last few years, what do you see for 2017? I know everybody's asking that, but do you think there'll be still this demand for housing and limited housing and price increases, or what do you see coming?
It's a great question, and I think that we are in an environment of such rapid change right now that it's, simply put, you can't make generalizations. Even as we've seen recently, the Federal Reserve increased the interest rates. We've got a rapid change in the cost of home ownership, and that's going to, I think, wreak havoc on everyone's forecast of what's likely to unfold over the next 12, 24, and 36 months. Our perspective is one who does a lot of forecasts in the marketplace is that generally we're going to continue to see rising home prices, but at decelerating rate of growth. We generally state that across the nation, and I think our perspective is at about 5% appreciation nationwide. But when you look at the norm across the nation at a more localized level, thinking, say, in terms of the individual MSAs or markets across the U.S., that dispersion is enormous. So while we talk about 5% nationwide, we project markets like Colorado, the Washington, Oregon, some parts of Northern California, Texas, Florida, we're seeing some wild growth rates that are all the way up to 11%. And it's both scary and I think exciting at the same time, depending on kind of what viewpoint you're looking at that from. Many of these markets, like the San Franciscos and Floridas, are getting to a point where prices are reaching what we expect to be a peak over the next few years. Not to say this is like the last cycle where we would see a sharp fall that would follow that, but rather that we're likely to see flatlining or slight declines after that because of the level at which prices got reached, and rising interest rates I think are going to take its toll on the ability to continue to see those sort of growth rates. In contrast, though, we do see a few markets that are really already seeing those peaks, and that's where you start to see the bottom end of that spectrum. A few of the markets that are very oil-centric have already begun to see that rapid deceleration, and we're seeing peaking over the next 12 months. Maybe not the most interesting markets for some, but you look at places like Bakersfield, Midland, Texas, some of the Oklahoma markets in Oklahoma City and Tulsa. These are markets where that slowdown is already very real. And I wouldn't say that it's scary, but the economic instability around the oil markets has created some issue with the job base and ultimately the driving demand. The contrast is that as we look back over the last cycle, and most of what we've seen over the last 4 or 5 years, we've seen something that you could generalize across the nation. And I think this sort of dispersion is something that we all need to get used to because it's likely to be here for the cycles to come. We're seeing these cycles go faster from beginning to end, so from peak to trough to peak. And we're seeing the cycles be much more rapid. They're coming more frequently and more dispersed across the markets, more locally centralized.
Fascinating. Okay. What would you say with the interest rate hike? Do you think that will affect mortgage rates? I mean, they're not necessarily tied together. The mortgage rates are more tied to the economy. So do you think we'll continue to see mortgage rates increase? Or do you think they might do what they did last year and take a little dive after the Fed raised rates?
Yeah, it's interesting. I mean, we were tracking that after the interest rate increase. We've seen those jump up a little bit on 30-year fixed, but not significantly. The initial indications are that it was fairly well priced in going into the Fed meeting. So I suspect that we're likely to see these things hold pretty flat or close to where they are today for the foreseeable future. And the Fed's given pretty good guidance that this is going to be an interest rate rise over the next 2 years of about 3/4 points. So I don't think we're going to be in an environment where we're going to see this stuff fall again like we did last year. But I think it's something that's good to keep your eyes closely on because of the bearing it has on the overall housing market. What I do think is really interesting coming out of the rising rates that we've seen since the election, I think it's going to take its toll on the demographic discussion we had earlier. The first-time buyer getting more expensive for them to participate in the marketplace. And when you think about what that means for folks that own rental properties, it means you're going to continue to have good demand. It's going to mean that you're going to have tailwind on pricing. The cost of homeownership is one of the most relevant indicators of what a rental price should be. And as we see rising costs of homeownership, it's going to really be a tailwind, I think, continue to buoy the industry.
Yeah, it's a great perspective. I mean, if interest rates continue to go up or even if they stay where they are, the concern is affordability, of course. And if fewer people are able to afford to buy homes, that does leave more renters on the table, right? More people who still need a place to live, but just can't own that property. So
it's a great point. One thing I'll add to that is if you look at the feedback you see in the press from, lenders across the marketplace, you listen to the think tank's perspective on this, the rising rates are going to give the opportunity for more creative mortgage. Obviously there'll be a little bit more buffer there, as well as, the stability of the overall marketplace would suggest that more creative credit approaches are going to be more prevalent in the marketplace going forward. I would say that's one of the big unknowns around the housing marketplace in the next few years. And generally, I don't think we're going to get anywhere near the stated income, stated asset type of availability that we had back in 2004, 5, and 6. But I don't think we're far away from seeing the easing of the access to credit across the markets.
Mm-hmm. All right. So with home prices rising and potentially rents rising and that affecting affordability, at what point does it just become too unaffordable and then things slow down? I mean, do you have concerns about that? Just housing being out of reach for the average person, whether they're renting or buying?
Yes and no. I think it's a very thoughtful question that requires a very complex answer. Mm-hmm. The reality is there's no generalization across the U.S. This is kind of a theme of a lot of my discussions with clients and the industry leaders. If you look at most of the United States, it remains to be very affordable in terms of the trend and the cost of homeownership over the long haul. Most markets remain very well in balance with their historical norms in terms of this cost relative to incomes and interest rates. But you see a lot of markets that attract an enormous amount of press where those have run wild. We talked earlier about San Francisco and the Florida markets. Those are good examples where they're getting to a point where they are close to out of whack from an affordability standpoint. What we've seen in this cycle is that many new markets are emerging as being attractive markets where people are fulfilling their housing demand by moving. And if I look back, and I'll give you an example of the last cycle, in places like Southern California, it got so expensive that you saw an enormous amount of exportation of demand to target markets, Dallas and Phoenix. If you look at the majority of kind of new migrants to those markets, you started to see huge California demand exported from California because of that cost. We haven't seen that same behavior. I mean, Dallas has its own story of, fabulous economic growth, but we're not seeing that same sort of exportation of demand from California to these historically been natural markets for migration for affordability. We're seeing the rise of many markets like Nashville, Tennessee, Colorado, Portland, desirable areas, but not usually on people's areas of focus for where I'm going to move next. They've tended to be B markets at best in relative to that migration pattern. And the markets like Phoenix don't necessarily have the same attraction, if you will. So this has been an interesting sort of pattern we've seen. And you look at the millennial in the marketplace and, the major affordability issues you see within that demographic cohort especially. This is where the markets like Austin is a perfect example where it's already well underway, this sort of gentrification that's attracted the young buyer. The Nashvilles, the Portlands that I mentioned earlier are extremely attractive and rapidly changing. And, the infrastructure is being built, technology investments are being made, high-tech jobs are going in. They provide rise to those local economies and, say, a new dimension of home pricing. So I think today they remain very affordable, although we've looked at those from our perspective as being very good investments because of how we've seen those real estate markets unfold.
Well, tell me a little bit more about HouseCanary and what services you provide, because this is a question I get asked all the time when I'm on the news is, how's the housing market? And it's like there is no such thing as a national housing market. It's all just thousands of little micro markets. What does your company provide to investors so that they know that they're in the right market at the right time and with the right deal?
Exactly what you said about those thousands of micro markets. Our goal as a company is to bring to bear a really concise but impactful understanding of the valuation, the risk, and the opportunity in each one of these neighborhood areas. We do analytics, forecasting, valuation on about 18,200 zip codes around the United States to get hyper-local about the valuation and behavior in those markets, where they're going to go over the next 1, 2, and 3 years, as well as do valuation on homes, about 100 million properties each month to make sure that there's good transparency on both what the value is and what's the rental value going to be. So we have a big investment in that space. We use tools like HouseCanary Value Report, which allows you to type an address in and quickly get a full detailing of the valuation today and out into the future, as well as the rental values, which, to me and what we've seen with customers, the pain point that so many find is how much is the home really worth and where is it going to be valued in the future? Is this a good investment? Because housing accounts, it's the number one line item in pretty much every family's budget. It's a question we should all be asking. And I think the tools that are generally available to the public remain to be very inaccurate and unreliable. So we've tried to bring some transparency to this space and very excited with the response we've gotten so far.
Oh, fantastic. Wonderful. All right. Well, any last comments about this election or, what we can expect this coming year or what opportunities investors have?
I would say there's a lot to talk about on each one of those fronts. I will say from an investor opportunity, the investor opportunity is fabulous right now. It's not the 2012 timeframe where you can buy everything cheap. That's for sure. But there's an enormous amount of tailwind that remains behind the marketplace. And while they may not be 20% growth year over year, there's a lot of markets that continue to grow at very healthy rates. And I think it's very apparent for an investor that you've got to look below the surface of a marketplace to identify the right submarket, the right properties. But when you're looking with the level of analytics or tools like we have available in the marketplace, you can begin to find the sweet spots. And I would say this is just a market where there's not going to be a huge amount of home ownership growth in the next couple of years. That seems pretty clear on the downward trend. So when you think about buying homes for investments or single-family rental, I think the tailwinds are certainly fall in your favor. I do think that with regard to the election and the question, I would say that there's really no expert on this right now. I think it's everybody's best guess. But what I can say is that the world's changing quickly. And with the introduction of Ben Carson being the head of the HUD, it's going to throw a lot of, I think, curveballs toward the marketplace and what to expect. I mean, he's gone so far as to say in his campaign that he wanted to dissolve the GSEs, change the mortgage tax credits, things of that nature, where that could have radical effects on the marketplace. So you could see many black swan events occur in a very short period of time. But my suspicion is that there will be a lot of pressure for him to hold constant in the near term. So we're pretty optimistic and will remain so until proven otherwise.
Fascinating. Okay, JP Ackerman, VP of Client Development at House Canary. Thank you so much for joining me here on The Real Wealth Show. It's been a real pleasure.
Thank you, Kathy. Appreciate it.
All right. So if you'd like to find out more, just go to realwealthshow.com, realwealthshow.com. You can join for free. That'll give you access to our weekly webinars and to our blogs and podcast. And actually, you'll be able to meet with one of our investment advisors who will give you a complimentary strategy session to help figure out where you are and where you might want to be. And if you would like to self-direct your IRA, invest it in real estate, in cash flowing real estate, in recession-proof markets where we have teams finding great deals, great cash flow properties, fully renovated with qualified tenants in place for what we call a real turnkey property. Again, you can meet with an investment counselor to walk you through that just by joining for free at realwealthshow.com. And of course, I highly recommend that you sign up for our Real Wealth Investor Academy. Just spend 5 minutes today watching the online video modules and you will transform your financial savvy. And it's only $10 a month. We've lowered the price to make it affordable for everyone. And you've probably heard on past shows that we're very, very proud to say that 100% of that $10 is going to the Real Wealth Foundation, helping those who are in dire need for support. Again, Real Wealth Investor Academy is where you can sign up for that education. All right, have a wonderful rest of your day. Bye-bye.